Well, hello there. This is Praveen again. In today's video, I'll be talking about the most frequently asked question when you run a business as a corporation. How do you pay yourself? Salary or dividends? Well, there is no clear answer. There is no clear answer to the question which one is better. We have to examine the cons and pros of both salary and dividends and make sure that you understand it all depends on individual circumstances and situation. Let us examine the pros of salary first. A salary is an expense for the corporation and it reduces the corporation's taxable income. Also, when you draw a salary, there is evidence of income for you. In case you want to borrow money from the bank for a loan or for a mortgage, the bank will ask you for documents like notice of assessment, T4 slips, or pay stubs before it can qualify you for those kind of requests. Also, drawing a salary creates room for RRSP contributions for you. You can contribute to your RRSP plans and reduce your taxable income. If you are planning to have retirement income for future, a salary comes handy this way. With salary, you are required to contribute to CPP. Now this comes handy if you wish to have a steady CPP income in future. Also, since salary is an earned income, you might be entitled to certain federal or provincial tax credits like employment tax credit or Canada Child Benefits. Now let's talk about the drawbacks of salary. When there is salary involved, the corporation will have to do a proper payroll. From the gross salary, you have to make deductions for income tax, EI, and CPP. And also, as an employer, the corporation will have to make contributions to EI and CPP. Plus, these remittances have to be made by the 15th of the following month. Failing to do so may invite a stiff penalty from the CRA. You may not have time to do all this yourself, or maybe you cannot afford to hire an accountant. So this is something to keep in mind when you draw a salary. Salary is taxed at a rate higher than that of dividends. But over the life of the business owner, taking all considerations of all factors, it really may be minimal. Now take a look at paying yourself dividends. Dividends are generally taxed at a lower rate than salary. Also, dividends are not subject to such contributions as CPP. And so this saves you almost $3,166 per year and the same amount for the corporation for a total of $6,332. Also, for paying dividends, you do not need to do payroll. All you do is write a check for yourself and that's it. Now let us talk about the disadvantages of dividends. Dividends are paid from after-tax profits of the corporation, so there is no tax deductions for the corporation. Also, since dividends are not considered earned income, you will not be entitled to certain credits like employment tax credits or Canada Child Benefits. You do not earn RRSP room, and since you are not contributing to CPP, you will not be entitled to CPP in the future. The next question is, which one of these two options is more attractive as far as saving on taxes is concerned? The reality is that there is a minimal saving on taxes in either scenarios. Canada's tax system is formulated in such a way that whether you pay tax as individual or as business, there is hardly any gap in there. Especially if your corporate income is under $500,000. This is because you would be able to claim the small business deduction for corporate income under $500,000. If that income was over $500,000, yes, salary might be a good option for your corporation. We will now examine two different scenarios. For simplicity, we'll assume that this happens in Ontario. We'll ignore all other deductions or credits that might be otherwise available. The figures will be based on the combined federal and Ontario marginal rates. John and Robert both run corporations. John decides to go for salary, whereas Robert says, okay, I will go for dividends. In the year 2020, both corporations made a profit of $130,000 before taxes. John pays himself $110,000 in salary. The corporate taxable income comes to $20,000. The corporate tax is $20,000 times 12.2% equal to $2,440. John's personal tax, $110,000 times 43.41% equal to $47,751. John's portion of CPP contribution is $2,898. Employer CPP contribution, $2,898. The total liability, $2,440 plus $47,751 plus $2,898 plus $2,898 equal to $55,987. Now let us take a look at Robert's situation. Robert takes $110,000, same as John, but as dividends. The corporate profit before tax equals to $130,000, same as before. The corporate tax equals to $16,250. The corporate after-tax profit equals $113,750,000. Robert's personal tax, $110,000 times 25.38% equals $27,918 at a rate of 25.38%, which is the marginal rate for Ontario. The total liability for Robert, $16,250 plus $27,918 equals $44,168. So Robert at present would be paying less tax. But let's say if John made RRSP contributions to the max from his salary, his tax bill would not be much different from that of Robert. So what is the bottom line? What is your financial goal in the long run? Your current financial plan, your current income level, your age. Would you need income from CPP and RRSP when you turn 65? If the answer is yes, then I would say take enough salary so you can make maximum contributions to CPP and RRSP, and the balance could be dividends. If you have no intention of borrowing money in the near future from the bank for a mortgage or some other purpose, and your primary goal is to save money, plus you do not care about CPP or RRSP income in future, then I would say dividends would be a good option. So consider the factors I just mentioned, and perhaps a blend of dividends and salary might be a good option for you. Thank you.